Welcome to The Explainer. Today, we're unpacking what I like to call an epic financial tug-of-war happening right now with Hess Midstream, ticker symbol HESM. We're looking at a stock boasting massive margins and a juicy payout while simultaneously flashing some truly terrifying warning signs. If you love a good market paradox, you are absolutely in the right place. So, picture this. Would you buy a stock with an 8.3% yield if Goldman Sachs explicitly told you to sell it? Let's dive right into this fascinating contradiction by looking at the exact data that has Wall Street completely split down the middle. On one hand, you've got an 8.3% yield that income investors literally dream about. But on the other hand, major players like Goldman Sachs have officially downgraded the stock to a sell. How can both perspectives exist at the exact same time? Here is our roadmap for today. First, we'll meet Hess Midstream. Second, the bear case. Third, the bull case. Fourth, guru frameworks. And number 5, the final verdict. Section 1, meet Hess Midstream, the Bakken giant. Okay, so who are they? Hess Midstream is a fee-based energy partnership operating a massive portfolio of midstream assets right in the heart of the Bakken and Three Forks shale plays. We're talking about a formidable company with an $8.2 billion market cap, trading around $40 a share with a PE ratio of 13.7. And just look at their past success, delivering a staggering 132.9% return over the last 5 years. But, let's move to Section 2, the bear case. 7 warning signs. Right, the crucial starting point here is a severe valuation gap. Guru Focus is flashing 9 separate warning signs, calculating a GF value of just $24.45. Compare that to the current price of around $40, and the framework suggests a near 40% overvaluation. Backing this up, Goldman Sachs downgraded them to a sell with a $32 price target. And amazingly, Valita's Warren Buffett patient investor model gives the stock a shocking 0% score. Literally a total rejection. But it's not just the valuation models flashing red, is it? There's some deep operational vulnerability here too. In Q2, revenue actually fell 3.7% year over year. Worse, analysts expect their revenue to shrink annually through 2026, while the rest of the industry actually grows. Why? Well, massive customer concentration. They rely heavily on Chevron and Hess. If production slows down, HESM takes a direct hit. Plus, Goldman Sachs highlighted a looming threat. Legacy fee agreements currently above market rates face serious recontracting risk. If they're forced to lower rates, those margins will instantly compress. And anchoring this entire bear case is this shocking number, a debt-to-equity ratio of 10.1x. This is a massive leverage number that we'll see act as an absolute deal breaker for some legendary investors a bit later in this explainer. But let's flip the script. Section 3, the bull case, 7 strengths. When you look at their execution metrics, it's objectively clear they run a highly efficient operation, despite those revenue headwinds. They beat Q2 analyst earnings estimates by 14%. But the real standout here, a gross adjusted EBITDA margin, which is a key measure of operational profitability, of roughly 85%. Combine that with a 20.6% return on invested capital, showing exactly how efficiently they use their money to generate profits, and 20 consecutive quarters of positive free cash flow, you've got a powerhouse. In fact, on Valitia's Buffett Fit engine, it actually scores a 69 out of 100, passing strict quality tests for margins and returns. And then there's this number, the massive draw that has income-focused investors practically salivating, a highly secure 8.3% distribution yield. This 8.3% yield isn't just a fluke, guys. It is backed by tremendous consistency. We are talking about 32 consecutive quarterly dividend increases. Management is aggressively pivoting to maximize shareholder returns, targeting 5% annual distribution growth through 2027, fully covered by cash flow and CPI-linked fee escalators. Add in a $100 million share repurchase program with $60 million already completed, and you've got a management team proving a fierce, unyielding commitment to returning capital directly to you. All right, Section 4, Guru Frameworks, the ultimate tiebreaker. When we run this massive clash of data through legendary investment frameworks to see how the pros would break the tie, every single one flags the incredible metrics against that terrifying debt. Starting with the mode analysis, it scores a narrow 5 out of 10. They have durable cost advantages from their scale, for sure, but they lack switching costs due to that high Chevron concentration. Next, Benjamin Graham's defensive model gives it a 73 out of 100. Graham loves the 7.3% earnings yield, but that 10.1x debt-to-equity ratio, total deal breaker. Peter Lynch's growth at a reasonable price model is mixed at 54%. The PEG ratio is a highly attractive 0.84, but again, the massive debt ruins the score. Finally, Warren Buffett's framework scores it a 69 out of 100. The business quality is undoubtedly Buffett-like, but the debt and historical share count growth make it a totally mixed bag. Section 5. The final verdict: quality versus price.
Ultimately, Hess Midstream presents a classic paradox. It's the ultimate high-quality business at a questionable price story. The execution metrics are exceptional. I mean, very few businesses operate with 85% gross margins and generate positive free cash flow for 20 straight quarters. But you're paying a premium valuation, and you're taking on significant execution risks, particularly concerning their heavy debt load and the looming renegotiation of those legacy Chevron contracts.
So why does this matter? Well, your personal investment strategy totally dictates the final verdict here. The data suggests that if you're an income investor, this stock deserves serious consideration. That 8.3% yields combined with 5% expected annual growth is highly compelling. However, if you are a deep value investor, this is a hard pass. The Guru Focus Value suggests significant downside risk with very little margin of safety if earnings compress. And for the framework disciples out there, it's simply a mixed bag. Incredible business quality, heavily spoiled by that 10.1x debt-to-equity ratio. Now that we've managed to cover all the points perfectly, I'll leave you with this final critical thought. Can Hess Midstream actually maintain its high margins as those legacy fee agreements roll off? I really want to hear from you. Are you willing to stomach the recontracting risk for that juicy 8.3% yield, or are you staying far away and waiting for a much better price? Let's get a conversation going below. Thanks for joining me for this explainer, and keep learning.